To get from our operating cash flow to our free cash flow numbers, we're going to have to figure out what our net cash investment in operating capital was. I've talked about operating capital before. This is going to be the collection of assets used for operating purposes, and they're specifically not going to be financial assets. So we're not going to be looking at stock in, say, a related company or a supplier. We'll be looking strictly at things that are used to drive the operation forward. Operating assets get classified into two categories. We classify them as either current assets or fixed assets. Fixed assets are normally capitalized, so depreciation is involved in these. Current assets are also called working capital. And what we care about in this case is our net working capital. It would be our current assets minus our current liabilities. In order to figure out net working capital as we use it in a free cash flow computation, we want to think about just what the current operating liabilities are. Not all liabilities are truly operating items. Remember, we're going to exclude financial assets, and therefore we'll exclude financial items from the current liabilities section. So for purposes of this discussion, net working capital is going to be our current assets minus our accounts payable and our accruals. This should be the same thing as taking our current assets and subtracting out all of our current liabilities except for our non-operating items. And if we want to find the free cash flow based on the author's numbers in Chapter 4, we'll start with our operating cash flow, which we figured out as being $322. And we're going to find the change in net fixed assets. So looking on the balance sheet, we can see that the net fixed assets increased by $200. And we had $100 of depreciation during the year. Remember, I said that fixed assets are typically depreciated. So what's happening each year is the value of the fixed assets on the books are going to be reduced by the amount of depreciation expense for the year. At the end of 2011, we had $1,000 in assets on the books, and during the year of 2012, those reduced by $100 of depreciation. So it went from $1,000 down to $900. At the end of the year, however, we had $1,200 in net fixed assets. So that means we had to have bought $300 worth of assets. We went from $1,000 down to $900, and from $900 up to $1,200. Our change in net current assets balances out in the instance that the author gives us. I don't find this particularly helpful, but it's good to know where the pieces are coming from. The reason I say it's not helpful is because when you're given a zero answer, it's hard to really determine exactly what was I supposed to do with that number. So here are the steps that I'm going to go through. I'll look at the total current assets and see how they have changed. Total current assets for the company increased by $100. Then we'll look at our accounts payable and our accruals. Accounts payable for 2011 add up to $700, and accounts payable and accruals in 2011 add up to $700. Accounts payable and accruals in 2012 add up to $800. So they also increased by $100. In other words, the total assets that we have and the increase in our accounts payable and our accruals are offsetting one another. So we have a $100 change in current assets minus the $100 change in current liabilities, just the operating items, and we're left with a $0 change in net current assets. You will notice this leaves out notes payable. Notes payable are financial vehicles. Notes have interest attached to them, and there's some sort of a contractual obligation around the structure of the payment and of interest and principal for that note. So that classifies it as a financial item. So we're going to exclude that from our computation of net current assets.